Welcome back to Financial Clarity for Doctors, everyone. I'm Corey Janoff, joined as always by Rachelle van der Zanden.
Hello.
And today we want to talk about a topic that actually one of you asked us about, but I've been getting more questions about it over the last couple of years anyways, here and there. But the subject is direct indexing. It's getting a little more attention in part because it's becoming more accessible to more people. In short, you need less money to access a direct index portfolio than you previously needed. So it's becoming less of a barrier to entry for folks. So today we're going to talk about what is it, what's the benefit of it, who does it make sense for, and you can help see if it's something that you should be considering for your investments, or if it's something that's not for you. So let's see, where should we start, Rachelle?
Yeah, well, I think getting some basics down ahead of time is always useful when we have these more technical conversations. So, the first thing we want to talk a little bit about is what is an index, which is not the same thing as an index fund, but the index itself. And basically, an index is just a measurement of price performance of a defined set of investments. So, people often think about the S&P 500. And the S&P 500 itself is a measure of the aggregate price value of there's about 500 companies in this, but it can vary a little bit. Like sometimes they drop off, sometimes they add on. But it's the 500 largest publicly traded companies in the US. So the S&P 500 itself is not an investment. It's just tracking the price of those 500 companies. And it can get really technical in terms of like how we design funds to track those indexes. And that's what like an index fund is. But there's also lots of different indices. So, the Russell 2000 measures the 2000 smallest US publicly traded companies. There's also, like indexes of global stock or foreign stock or, specific sectors like real estate, healthcare, tech, all of those different kinds of things. And you can't invest directly in the index, but there's lots of different index funds that are designed to track those indexes and help you participate in the performance of those indices. Oh my gosh, complicated.
Correct. Yeah. And yeah, there's a lot of indices out there. I've seen some estimates that there's actually more indexes than there are stocks. So, which means there's a lot of overlap between companies that are on multiple indices, if that's the correct plural form of index. I think it is.
I think so.
Yeah. So, like, for example, a large, tech company, will be on the S&P 500. They'll be on, the 500 growth index, the Russell 1000 growth index. They'll be on probably the NASDAQ 100. So there is a lot of overlap. And some indexes are just broad, large US companies, small US companies, growth companies, value companies. Others are like really specific, such as like a sector fund, like healthcare stocks, for example, or a real estate index.
Or
And
the
then
cannabis index.
yeah, and it even gets more boiled down. Like there's cannabis indexes that track marijuana companies. There's cybersecurity indexes that'll track companies dealing specifically in cybersecurity. So, any subset of our economy that exists out there, there's likely one, if not multiple, indexes or indices that track the companies dealing in that world. So you can get really specific, you can be really broad, or all of the above. So to invest in, said index, we can't invest directly in the index, but there are generally mutual funds and ETFs, which for your concern are more or less the same thing. It's just a collection of a bunch of different stocks. They trade a little bit differently on the exchanges, but mutual funds and ETFs that, we'll try to track that price performance, as Rachelle said, of those underlying indices. So for example, if we're investing in an S&P 500 index, it's trying to track the price performance of the 500 largest US companies, and it's pretty easy. Well, maybe easy is not the right word. It's pretty straightforward to operate an index that tracks something like the S&P 500. You just buy all 500 company stocks. Very simple.
Yeah.
You could
Just
write
have to have some fancy algorithms, basically.
yeah, you could have a computer program run the fund. Now they're not going to buy all 500 stocks because there is some turnover from year to year. But they'll probably buy the majority of them, a large representative sample. And you start seeing that more so with, smaller indices like the Russell 2000, for example, which is the 2000 smallest companies. There's not going to be 2000 stocks in that index fund, because they would have to change over quite frequently as companies get larger and move off that index and go to like the mid cap or large cap index. If companies go out of business, go private, merge, get acquired, so it would be kind of hectic if they're constantly trying to buy all 2000 of those companies. So they just buy a representative sample that based on their work and the algorithm, et cetera, is going to pretty darn closely track that underlying index. Now, relatively straightforward to track an index of heavily traded companies like the S&P 500. It becomes more challenging to replicate some of those smaller indices like the cannabis one, for example, where the company stocks might not be as heavily traded. So you're going to have a little bit more price disparity, and it's going to be harder to track perfectly, but it'll still be pretty close.
Definitely. Yep. I think that, they're all trying to accomplish the same thing, which is allow people to participate in the market in a really broadly diversified way without having to have a bunch of money to directly invest in these individual companies, which is where, this direct indexing kind of comes in a little bit more. And the benefit of those investing in the index funds themselves and ETFs and things like that is that they're typically a fairly low cost compared to a lot of actively managed mutual funds. It's just like we talked about before, run by a computer program, and you don't need a lot of resources or as many people to run a fund that's based on an index. You don't need a whole bunch of research analysts deciding which individual companies to buy and sell because the computer is telling you which individual companies to buy and sell. There's often less turnover with the individual stocks that the fund holds as well. And that comes down to basically the fund itself trying to buy and sell those individual stocks to more, closely align with what the index itself is. Mutual funds or actively managed mutual funds do that a little bit more as they think like, okay, this company is good to hold on to, this company is not good to hold on to. They make decisions based on whether or not they think that the price is appropriate for that stock anymore. An index doesn't necessarily care if the price is appropriate for that stock. They're not going to do a whole bunch of research about that. They're only going to sell it as the position changes within the index. So the turnover itself can create what's called capital gains taxes, which is where this conversation is going to go a little bit more. But basically, if the fund is selling out of an individual position or even selling part of that position, they pass capital gains on to their shareholders. And then you have capital gains that you have to claim on your taxes because the fund sold part of an investment. And then so even in an index fund, there's some turnover, even if it may be less than a mutual fund. So that's one thing that can be an advantage to index fund because it's less, but also, we're going to go into a little bit more of how that can be potentially a bad thing. Statistically, also, a lot of index funds outperform actively managed funds. Like if you look at it in general, just statistically, they do. Like there are some funds that fall outside of that, some actively managed funds that have outperformed. But if you give them long enough, a lot of times, most times, index funds will outperform. It's kind of like, when we're trying to pick and choose winners and losers, we don't do a great job because we don't have all of the information. There's lots of things that are really, really unpredictable about how companies will perform longer term. So we're trying to make educated decisions with incomplete information. And that can be really hard to do.
And I think it's not necessarily that the funds can't outperform on a nominal basis. It's when you factor in the costs of operating an actively managed fund, net of expenses, it becomes more difficult to beat the index. Just because the index fund has a much lower overhead, so much lower
Absolutely.
hurdle to clear. But that doesn't mean like they can't do it. Like there's a number of active funds out there that consistently beat their benchmarks, consistently outperform over time, or maybe the just sheer performance isn't the objective you're shooting for. You're trying to look at a certain strategy. Maybe you want like a risk adjusted fund that the objective is to go down less in bad years and go, but it's going to go up less in good years. And yeah, over time, you're probably going to have less performance in the positive direction, but it's going to be a smoother ride for you. So there's, different strokes for different folks, right? You have all sorts of sizes and flavors of investments out there. Um, so yeah, we don't want to just be super sheer, narrow minded when it comes to looking at these things. But yeah, so index funds appealing for most people. Like if you're a do-it-yourself investor, I usually encourage you to just stick with index funds. It's simpler. You can be diversified without too much thought involved. But if you have the tools and the resources to really analyze and understand what some of these investment funds do and objectives are, then yeah, it could make sense to expand beyond the plain vanilla index funds a little bit. Um,
Definitely.
but let's see, direct indexing. So we have the index fund, which allows you to be the big. I think when we might have glossed over a little bit, diversification is a big thing here, and it's up. We're spoiled nowadays where there's like zero minimum investment requirements. There's essentially no trading fees on stocks anymore. If we were having this conversation 50 years ago, like, what, like index funds didn't exist. You had heavy commissions when you were buying or selling stocks. Like it was a lot more difficult to invest your money than it is today. But mutual funds, index funds, ETFs, they allow you to diversify with essentially $1. Like with your first dollar, you can own thousands of companies. Um, and diversification is important, for a number of reasons. You don't want to throw all your eggs in one basket because if a company goes out of business and that's the only company you own, well, your money is now zero. So we want to spread that risk around, invest in a little bit of everything. You'll always be invested in the best performing thing in a given year, and you'll never be overly exposed to the worst performing thing in a given year if you're well diversified. So for most people, ETFs, mutual funds, index funds, that's the way to go because you don't have the ability to invest millions of dollars right out of the gates. But if you do have a healthy amount, and it doesn't have to be millions, it could, be as little as like 250K or 500K, but that's where we could start exploring some of these, a little more advanced strategies, maybe is the right word. So a direct index is rather than buying, an S&P 500 index fund where you're a shareholder of the fund, you don't actually own the stocks themselves, you own the fund that invests in those stocks. Your money is pooled with a bunch of other people's money. With a direct index, it's you got to typically do it through a third party company. It's called a separately managed account where you have a manager working on your behalf. I suppose you could do it yourself, but that would be very cumbersome and time consuming. But you're actually going and buying the individual stocks to replicate the index's performance. So if it's an S&P 500 fund that you're trying to replicate, you're going to buy the 500 companies, or maybe not all 500, but a strong representative sample of those companies to ultimately mirror the performance of the index. So because you have to go out and buy the individual stocks, you need a decent amount of money. Most companies probably require at least $100,000 to do, an individual index replication for you. But with that comes some benefits, most notably on the tax side of things. So you can, in a given year, let's say the S&P 500 is positive. As in aggregate, it's positive, but probably, you know, 60% of the companies were positive for the year and 40% were negative on their stock. I'm just making this up, but hypothetically. So in whole, we're positive, we're happy, but 40% of our portfolio was actually down. Um, when it comes to taxes, you only pay taxes when you realize a gain on an investment, which means you're selling an investment for more than you bought it for, or receiving a capital gain from a fund that sells the investment. But losses offset gains dollar for dollar. So if we have 40% of our portfolio negative, we could single out those individual positions and the individual tax lots, which are, every time you buy a position, it creates a new tax lot at the share price you bought it at. Losses offset gains dollar for dollar. So we can single out the losers, sell them, use the losses to offset gains elsewhere in the portfolio. So if we wanted to move off a winning position, we could with minimal tax impact. It allows you to rebalance more effectively. And it really helps mitigate the tax consequences of investing.
Yeah. Is it also partially that after you've held the funds for quite a while, if there are, positions that maybe have decreased in value in the index, but you have lots of gains in that, you can choose to hold on to it? And do they sometimes do that with these SMA funds?
Mm-hmm. Yeah.
Yeah. So
So the first and foremost, I think the goal is replicate the index, but like the objective 1A and 1B, 1B would be minimize taxes. So
yeah.
most all of these direct indexes are proactively tax loss harvesting. Now they might not do it down to the penny every day. Um, because it becomes a little cumbersome if we're harvesting $1 worth of losses. We have to move off of an entire position just to save $1. Maybe not worth it. But yeah, they'll try and single out, all right, which positions can we get rid of, and then what positions can we replace them with to still mirror the index, but reduce our tax bill as much as possible. So maybe as a whole, you put your $100,000 in, the fund is worth at the end of the year 120,000. We had a 20% gain in the index fund for that year. But let's say on paper there's also 10,000 of losses within the fund. So we have 30,000 of gains, 10,000 of losses for a net 20,000 gain. Well, let's single out those 10,000 of losses, uh, which is going to save us in capital gains taxes, because that $10,000 loss will offset $10,000 worth of capital gains elsewhere in that portfolio or in other portfolios. That it's you as an individual person, your taxes, that aggregates across all your accounts. And if you have a net loss for the year, more losses than gains on paper, you can deduct up to $3,000 off of your income for tax purposes. And then the excess loss carries forward to the next year to be, used to offset future losses. So
Yeah.
it becomes, those numbers just become more impactful the bigger the account is. If we're talking, 10,000 of loss, sure, it'll save us a few thousand in taxes. But if we have $1 million and it's $100,000 in loss, and now we're talking about potentially 30, 40,000 in tax savings. Um, okay, now we're
That's
talking.
powerful. Yeah,
Yeah.
absolutely. Yeah. I'm sure that one other benefit is also that as we're having to sell things that maybe have performed well, if we can choose older tax lots that now have long-term capital gains instead of short-term capital gains, like that can be really helpful. And there's all sorts of things from a tax planning perspective that we don't necessarily think about when we hold mutual funds because we don't have as much control over it. But yeah, I think it could make a lot of sense for people that have quite a bit of money to invest in these taxable brokerage accounts.
Yeah.
Yeah.
Now there are
Well, I think,
additional
oh,
costs associated
yeah,
with it, because you're going to have to pay the manager for overseeing that direct index that's being replicated for you. Um, but you're avoiding the fund expenses. Like if you're investing in an index fund, you have your mutual fund expense or ETF fund expense. So it's a little bit of a offset there, but still the management fees will be a little bit more expensive as a result, versus if you just went out and bought a portfolio of some low cost index funds. But the idea here would be that the tax efficiency over time outweighs that management expense on the portfolio. Otherwise, like, why would you even bother doing it? So really, like, it's really geared towards one, people with larger portfolios that have the means to do it, because we don't just want one index. I mean, I suppose you could, but if we want to be truly diversified, you probably want, the S&P 500, maybe the small cap index, an international index. You're going to want a few of these to have a well-rounded portfolio, but it's geared towards someone who is in a higher tax bracket to where, tax efficiency is more of a concern. If you're a resident in a 12 to 22% tax bracket, like it doesn't matter that much. Your capital gains taxes aren't really hurting you.
They're not rocking the boat too much, that's
No.
for sure. Yeah. Yeah. So I'm sure you could, if you wanted to just do the S&P 500 and maybe you could hold, your foreign assets in a regular mutual fund account or something like that. I'm sure there's like some moderate ways or kind of like a little of this, a little of that ways that you could approach this.
For
But
sure.
but you'll definitely need like a good chunk to start. And I think maybe you might need a good chunk in cash to start. Also, existing brokerage accounts could potentially be used for this. But, if you've had those assets for a while, you may already have a lot of capital gains in that account. In order to switch into something like this, you'd have to sell those positions to use that money to buy these new positions. And that is automatically going to trigger gains if you have growth in that account. And so, that's the opposite of what the point is. We don't want to trigger a lot of capital gains to avoid capital gains. Like it just doesn't necessarily seem to make sense unless your income tax bracket is going to be changing and it's going to be higher. And that could potentially be a reason to do that. But
Yeah, you just
yeah,
have to do that cost benefit analysis. Like, hey, I've got
absolutely.
a $250,000 brokerage account. And, coming off of 2022, where we had a big down year, a lot of your gains from the previous years, unrealized gains, were probably wiped out. And then even though this 2023 has been positive, you may not, have fully recouped the losses from 2022. And yeah, maybe you're, only sitting on like a 20 or 30,000 unrealized gain. And you just got to, make the decision. All right, if we were to sell out of this, we'd have, a little bit of tax implication now, but, moving forward long term, do we feel like this would ultimately be more beneficial in the long run? So,
Yeah.
short-term pain for long-term gain. But yeah, if you have cash, it makes it a lot easier because then you're starting with a clean slate. So a little more of an analysis needed for someone who who has an existing portfolio. But that's where, like you said, Rachelle, it might not be an all or nothing thing. Maybe, all right, let's do the S&P 500 for our domestic large cap exposure with this direct index. So maybe we got a 500K portfolio. Let's carve out 100K of it to put in the S&P 500. The rest stays in our more traditional ETFs, mutual fund strategy. And you can still have a very tax efficient portfolio operating with kind of this hybrid allocation, if you will. So we've got, one sliver that's extremely tax efficient, the others that are, pretty darn tax efficient, and life's good.
Yep. Definitely not for everyone. Like Corey was saying, if you're a resident, I don't know why you would maybe do this. Like, there's not a whole lot of income tax consequences with capital gains, but your income will be increasing over time. So obviously, it can be a consideration. I think it also may be overly complicated for some people. There's lots of folks out there that just want to keep things simple and not introduce a lot of things that create things that they may not be able to track on their own very well. Like there's less control. Like we have to, especially if we're having an SMA help, like it's probably a longer term commitment. We don't necessarily want to, switch that strategy up because obviously there could be some big capital gains consequences in the future if you decide to make changes.
Yep.
Yeah.
I mean, I guess you could, you know,
Roll it over
say,
in kind and
yeah, just roll it over,
yeah.
roll the individual position. But yeah, you still got those individual positions and the tax lots associated with them. So yeah, it's going to be
Yeah.
yeah, don't just say, oh, this seems like a fun thing to try. It's, you'll want to, probably be serious about, hey, this sounds like a good strategy for a long-term investment, tax efficiency, et cetera. And yeah, I mean, that's really the big objective is what's the most tax efficient way we can do this. And this is for your, traditional stock, bond, mutual fund type portfolios, this is arguably going to be the most tax efficient way to go about it. But yeah, it does add some complexities, some additional costs and headaches and challenges that, you may or may not want to deal with. So
Absolutely. Fun to explore new ideas. That's for sure. Yeah.
Keep the questions coming. We appreciate them. We'll see you next time.
So long.